To talk more about IT, we're now joined by Omkar Tanksale, the Senior Research Analyst at Axis Securities, on the show now. Omkar, morning. First, your thoughts on Accenture. What, according to you, is the biggest takeaway? And how would you read the weakness in consulting? Because while the Indian IT companies do not directly get we do not have a direct exposure to consulting revenues the way Accenture does, but consulting is seen as a lead indicator for discretionary technology spend. So when consulting revenues slow down, there is a probability that eventually down the line, tech spending will come under pressure. So your thoughts on Accenture?
Yeah, I'm positive about the Accenture results for Q4FY22. However, the only concern about me is the moderating the growth because of the uncertainties from the world's largest economies of the world. That may moderate the growth performance that FY20 that the Indian IT services also has been likely to be concerned. One point of view that one should look upon, as the deal wins came at 18.4 billion, which versus $17 billion in the previous quarter, which continue to be robust, and demand for the outsourcing has remained resilient in spite of the uncertainties from these economies of the world. So I believe the demand for as businesses becomes depending more on the system driven, and but the dependence is getting higher. So the dependency will likely to fetch more resilience in business in terms of outsourcing. However, because the uncertainties will lead to the more discretionary spend cuts that will likely to be happen for the next couple of quarters at least.
Omkar, good morning and thanks for joining us. This is Pavitra. You know, so far what we were really discussing was the margin pressures, but this time, even with Accenture's sort of revenue guidance, it does seem like demand concerns are also now going to start showing up. How much do you think you could see demand moderating for some of the larger IT Indian players?
I believe the demand will likely be consistent as they have grown previous quarter. For this quarter at least, the growth we can see at around 0.5 to 3 or 4% of the growth for the quarter-on-quarter basis for this quarter. But next couple of quarters, quarter 3 and quarter 4 will likely to be one should look upon vigilantly while the spending gets coming from the verticals that they are facing.
All right, Omkar, do stay on. We'll just come right back to you. But there's some more news that Rima wants to fill us in on. With several brokerage conferences in recent days, we've been getting a lot of comments from key IT companies amidst rising demand concerns across the sector. So today, the focus is on HCL Tech. Rima is once again back at the big wall with all the details. Rima.
Thanks so much for that. Well, you know, for HCL Technology, one of the most attractive features is its valuations, which is cheaper than peers. So let's pull up the valuation picture for FY24. HCL Tech at 15.5 times has always historically traded at a discount to peers, and this time as well it is trading at a discount, as you can see. Now, last quarter's numbers were a particular miss on the margin front. Margins for HCL Technology came in at a decade low, and this chart here will show you how the margins have fallen from their post-COVID peak. In fact, at one point of time, the margins were as high as more than 22%. And the street was worried that after a 17% drop-off in margins in Q1, can the company meet its full-year margin guidance of 18 to 20%? So on the topic of margins, this is what the management had to say. They said that Q2 margins will be better than Q1, despite the wage hikes and attrition, which means quarter-on-quarter there could be some expansion on the margins. The company is still on the hunt to achieve the lower end of their FY23 margin guidance of 18 to 20%. So they're holding on to the margin guidance, but it's going to be at the lower end. And the focus, the CEO said, is on improving margins over the medium term, once the supply side situation is perhaps eased. On growth, the HCL Tech management is fairly confident about achieving its FY23 revenue growth guidance of 12 to 14%. That's the guidance for the full year. They say that despite the macro volatility, the uncertainty, the pipeline has seen a very strong conversion so far this quarter. The demand is solid in the near term across all parts of the business, except for segments such as mortgages and the department stores. The big change in the management commentary is the percentage of cost takeouts in terms of deals, versus the transformation deals. And now what the management is saying is that we're seeing more of the cost takeout deals versus the transformation deals compared to just 3 quarters ago. And finally, as we wrap this up, a quick word on what the street is going to be watching. Will the company be able to meet its margin guidance? It appears to be a tall task. Not everyone on the street is very concerned. And secondly, it also has a very high exposure to engineering R&D, ER&D as it's called. In the past macro cycles, the ER&D outlook has been impacted due to the macros. This time, the management is saying it's going to be different, but the street is going to be watching out for the ER&D outlook for this year as well as next year very closely. Back to you.
All right, Rima, thanks a lot for that.